Good afternoon and welcome to this session on financial resilience, front of mind for so many organisations as a result of the events of the last 12 months. I'm joined this afternoon by a panel of experts from HSBC who are well placed to provide some really thought-provoking comments, not only on the impact of the pandemic, but on possible responses to that impact. The breadth of panel experience should provide something for everyone, irrespective of the scale or complexity of your particular organisation. Definitely a session to make use of the notes facility on the platform, which is the tab next to the Q&A button. And that actually brings me to housekeeping. As usual, please do submit questions as we go along, and we'll try and cover as many of them as we can in the time. This session is being recorded and will be made available for replay on the event platform by the end of the day. And please do get involved with the ACT on social media. Join the LinkedIn group, follow us on Twitter at ACT Update, and tweet using the hashtag ACT Treasury Forum 21. Right, let me make some introductions. For those of you who don't know me, my name is Sarah Boyce, and after over 20 years in corporate treasury, I now provide policy and technical support here at the ACT. And joining me this afternoon are Graham Boyd, who is Managing Director, Head of Corporate Finance Solutions, Global Banking and Markets. Laura Wilson is Director in HSBC's European Leveraged and Acquisition Finance team. Richard Fagan is a Managing Director in HSBC's Equity Capital Markets team. And last but by no means least, Andrew Robinson, is European Head of Sales for Global Trade and Receivables Finance. So it seems very logical, I think, perhaps to start with some scene setting. And Andrew, I know that you've seen some interesting developments, in particular in supply chains, of course, the smooth running of which are absolutely fundamental to businesses. So perhaps we could kick off by explaining a little bit about what the pandemic has been teaching us about the global trade system.
Thank you, Sarah, and thanks to the ACT on behalf of the panelists for the opportunity to present to members. Yes, the way that we wanted to structure this sort of debate is that clearly supply chains, sales and procurement of raw materials fundamentally start of being affected by the pandemic, and how those impacts flow through to the balance sheets and financing with my colleagues. So I can base some of my comments come from the HSBC Navigator survey, where we surveyed 10,000 clients in 39 countries. So insights from that survey, which is available online to participants. And obviously some of the trends that we've seen in our own operations within the European sphere and the broader global sphere. So a couple of points that we've seen. Trends that were already in place have rapidly accelerated in response to the pandemic. So in terms of clients adopting digital processes, clients going on an ESG journey, trying to improve that environment, social and governance perspective. We've seen a huge acceleration in requirements there. On the digital side, obviously, I think in the early stages of the pandemic, how do you physically interact with your bank? How do the banks interact with clients when we're all operating in a remote environment? Wet signatures. So a rapid evolution in that space towards digital communications, banking and systems we've seen, and a quick reaction, I would hope, from the banking sector to address that. Clearly on the supply chain, 93% of the respondents to the Navigator survey were concerned about supply chain resilience. So the ability to physically source your goods, have them shipped. This is all really about physical logistics if you're in the physical goods market. Clearly, if goods cannot be moved because ports are closed, roads are closed, countries are in lockdown, that has a massive impact on how countries and corporates can operate. So we've seen a lot of stress in the system there, and some successes of how corporates have adapted. Clearly, as I mentioned, a trend in the impact on physical goods. Obviously, in the non-physical market, the digital services, streaming, cloud-based type activities, huge movements in terms of adoption of those companies, and obviously from what we see, a K type recovery. So K, obviously the upside being those companies that have been able to pivot quickly to digital, that have gone from maybe a business selling direct to its customers, so business to business or business to customers directly, rather than rely on intermediaries. So a pivoting there. I think the opportunity in terms of when clients are adjusting supply chains, if that is required, that provides. I hesitate to use the word opportunity, because obviously the pandemic has caused a lot of distress, and obviously a lot of people have passed away, and it's tragic consequences. But I think in terms of when suppliers change or corporates change their supply chain, if you're onboarding a new supplier, perhaps in a jurisdiction closer to maybe a nearshore, then effectively, how do you onboard that supplier? Do you contract with them or transact with them digitally? You're not going to use post, so it's an opportunity to make it as efficient as possible. Or do you want that supplier to be ESG compliant? Lots of companies are on that journey in terms of ESG, and I think we've seen a big acceleration in terms of the ESG agenda. Just a couple of examples. I mean, ESG is we see that as performance enhancing, and one of the reasons is that if you're on an ESG journey and you're looking at your suppliers, you're effectively understanding more about the risks in your supply chain, the components of that supply chain. So, for example, if you are reliant upon a supplier that use dormatized labor, i.e. a workforce that retires to, say, an apartment buildings that are all where you've got a heavy occupancy. If you know that, you're clearly going to want to know whether they have sufficient sanitization, masks, etc., all of the COVID-related protections. If you don't know that, the likelihood is you'll probably find out when your supplies stop because the factory's closed. And that's a very practical example. Similarly, if you have two factories or two suppliers in a stressed water area, one has a water retreatment plant, one doesn't. You obviously know what the resilience is. If you're blind because you haven't gone on that journey, I think you're less able to manage those risks because you don't know about them. I think so we've seen companies go in depth, suppliers, the supplier, and obviously reputational risks abound in terms of who are your suppliers and how you can manage that. So a huge increase in the ESG element. I think the last point I would say is the role of government. That's clearly been extremely important in terms of support to corporates through various schemes, both at the top end and the smaller business end. I think there is a difference between the larger corporates obviously have more flexibility, more financial resources to manage their supply chain than the smaller corporates, which clearly have challenges in terms of that. However, I think it also depends on how flexible a large corporate is to suddenly move its supply chain and basically be able to adapt. A couple of examples: if you have let's say you produce goods in Europe, you have a centralized warehouse in Europe, but you can't move your goods now because the transport network that you relied on is no longer there. So we've seen corporates establish warehouse facilities in Asia and ship directly straight as the goods are produced out of the factory to a central warehouse in Asia, and then be able to supply to their client base. We've also seen a different. This pandemic is not everyone is in the same position at the same time. So we also see dislocation of trade flows where perhaps the factories in Asia are back and running and up and running, but the processing plants in Europe are closed. Now you have the challenge of how do you balance that? And similarly with containers, obviously used in a lot of trade, out of position. So how do you get the containers back to the ports that need to fill them and deliver the goods? So very from the trade perspective, very based on facts on the physical movement of goods, how clients act with digital. The last point I would say is be aware of obviously we've seen a lot of fraud in the market in terms of attempted, as everybody is at working from home. Digital interface with a financial institution is our view is the best way to go forward, rather than if you're still relying upon faxes, emails. I think there's a vulnerabilities there that obviously we are looking to address. So big movement on digital and ESG would be from our perspective.
That's really helpful. Do you think that the difference between winners and losers through this process it sounds to me as though it's not really as straightforward as being large versus small corporates. Is it more technologically advanced, less technologically advanced, or are there any? Is there such thing as a winners and losers actually?
I think there is. I think it comes down to. I think there is a distinction between the larger companies that have financial resources that can support their supply chain, and they can put cash into that into suppliers. For example, one of the scenarios we faced is where if you're dealing in a smaller market and you have a logistics provider, say, that provides trucks and lorries and moves your goods, and that is let's for want of a better word, a family controlled business. Let's say you have 40% of you represent 40% of their turnover, and the local market represents 60. If that local market has gone because they've closed down, then you now have a problem, because that company is not going to be able to operate as efficiently on 40% of its turnover and may actually stop. So what do? You may have to actually put cash into that business. They may not be bankable from a normal corporate perspective. We may not actually be in that market, or may not have the credit appetite. So corporates that have the flexibility can put cash in to assist, because it benefits their supply chain rather than not have those goods. But I think there's also the smaller companies that we've seen be flexible in terms of their speed of reaction, to make decisions quickly and to understand their supply chain. If they know and they're very quick to pivot and understand the risk in their supply chain, they have been successful. If they are less clear, if their supply chains are opaque, then it becomes much more difficult. And I think if you're a very large corporate and you have a rigid supply chain, you have a challenge. The new sort of phrasing that people will have heard is, it's not just in time, it's just in case. I could run out of critical stocks. How do I replace them? And where supply chains have been run purely for I would say profit and efficiency, there's no slack. And I think that is where we're seeing more built-in redundancy into the system, to ensure that if there is a disruption, then the corporate can continue to produce. So it is a complex picture.
Yeah, it certainly sounds like it. Actually, that's a really interesting point that you make, Andrew. And before we turn to sort of looking at some of the responses of the market to it, just very briefly talking about the just in case, just in time, globalization, or the retrenchment from, I know you've mentioned onshoring a couple of times in your comments. Is that a trend that you're very much seeing, or is globalization dead?
I don't believe. We don't see that globalization is dead. I think what we've seen is a restructuring of where goods are produced. So we now see, say, China +1, China +2. So your core business or your core production site is still in China as a major supplier, but you may wish to diversify a little bit in terms of having another site of production, maybe in a different geographic area, because the lockdowns tend to be geographically focused, so Europe or Asia, etc. And you could see, China +2, so a regional focus in China, then an Asian focus, and then perhaps something closer to your home if you're talking about a European corporate. What we've seen is China's actual market share has actually gone up, although they may be supplying less goods to the US. They're supplying more goods intra-Asia, and then those Asian countries are then supplying to the US. So we've seen an increased area. So I think, is globalization not? We think globalization is still a powerful force, and that there's some slight movements, but by no means is it we're all retrenching and onshoring. That's not what we're seeing.
Okay, that's very interesting. So we could spend 45 minutes just talking about supply chains, I think. Anyway, we need to focus on financial resilience and balance sheets, at least just a little. So perhaps I could turn to you, Laura, and we can talk about initial response to the pandemic. What sort of approach did you see happening in the bank market at the outset of the crisis?
Sure, thank you, Sarah. So I think that the first point I would make on that is that, at the outset of the crisis, clearly we had pretty much zero visibility in terms of how the crisis might develop and the potential impact on our clients in terms of their operations, their credit metrics like leverage, their ratings position. And yet, despite this uncertainty, the bank market was actually one of the the only financing markets that remained fully open right at the very beginning of the crisis. And certainly, lenders were generally very supportive of their core clients. They provided incremental liquidity facilities, approving covenant amendments and waivers, and all within very short turnaround timeframes. And perhaps just to give you some stats around this, to put it into context, if you look at the period last year, beginning April, ending May, so really that initial critical COVID period, we saw over $200 billion of new bank facilities being raised in EMEA alone. And that compares with $110 billion over the same period in 2019. And of course, then we also had the benefit of quite material volumes from M&A transactions as well. And so, yes, whilst we certainly did see some retrenching of banks, more so on a sort of a local geographical basis, I think this overriding stat, really does illustrate that in contrast to the 2008 financial crisis, right now banks are in a much healthier position, allowing them to extend balance sheet support to their core clients. I think also the other sort of helpful point to consider is just how banks were processing these requests for new liquidity in the context of that very limited visibility. And really, the only credit metric that we were able to sort of realistically assess at that point was all around their liquidity levels. So, what was a corporate's available sources of liquidity? How well diversified were they in terms of funding sources? Were they able to access capital markets when they reopen? What were management's estimates in terms of cash burn? How was cash being managed through working capital, through dividend policy? These are all the types of questions that we were discussing with our clients. And I think it just really demonstrates the fundamental importance of some of these areas when you're thinking about your sort of optimal balance sheet structure. And then the other sort of key takeaway for me personally coming out of the COVID experience was really that sort of very critical importance of having a very strong two-way relationship between banks and borrowers. And this was massively demonstrated during those first few weeks of the crisis. And it was actually very apparent that those borrowers who had the greater success in terms of managing their additional liquidity needs, they tended to be the ones with a strong lending syndicate in place, with banks who were able to provide a combination of both balance sheet support, but also, longer term advice around how to tap the capital markets. And I think it's also, it's very helpful to have perhaps a sort of inner circle of select names within your banking syndicate that you can use to sound ideas and who can really demonstrate market leadership in terms of driving consensus views across the wider banking syndicate. And then just to finish on this point, clearly, as we all know, after those first few weeks of the crisis, very quickly, alternative routes to raising liquidity opened up. So we had the government funding support schemes, we had the reopening of capital markets, as central bank support became evident through the various purchasing programs. And certainly, going into the summer period, we saw loan volumes fall considerably as those corporates that had the rating, were able to refinance their longer dated, their banking facilities through longer dated bond issuances or possibly by equity raises.
Okay, thank you for that. Graham, what about the credit rating agencies? Did they manage to cover themselves in glory on this particular occasion? She says somewhat cynically, being a very, very old school treasurer.
Well, I think, Sarah, you hit the nail on the head. Last time round in the financial crisis, I think it's fair to say that they probably didn't cover themselves in too much glory. And actually, in fairness to them, they did look a lot more internal into what happened. Why were there, 5-6 notch downgrades in the space of 6-9 months amongst quite a significant number of the companies that they rated? And the response has been really now to try to look through the cycle, and a lot of them have made a huge emphasis of this, trying to look through the cycle. This obviously isn't a cycle, this is a pandemic. But what we have seen again is, where possible, they've tried to look through the pandemic. And why do I say where possible? Well, it's because obviously some companies' leverage has just unsustainably risen to a level where it's not going to come back particularly quickly. But where that's not been the case, what we've seen is that the rating agencies generally have looked through towards the end of 2021, but actually more commonly towards mid-22 and towards the end of 2022, to try to see if credit metrics can return to that level of normality, back to the thresholds that they previously had. I've done that with a fair degree of success. So in the EMEA region, they've only actually downgraded or put on negative outlook about 35% of all of the ratings. And as I said, nearly all of those would have had credit metrics that simply, in their view, couldn't get back to where it was meant to towards the end of 2022. Of the ones that were downgraded, is no surprise, the sectors most heavily affected were high street retail, lodging, cruising, airline, and maybe less obviously for some was the oil and gas sector, where again we saw quite significant falls in oil prices, but also in volumes. And these were just simply industries that, if you look to the end of 22, they weren't going to get their credit metrics back to thresholds by that period. But it's all changed again. I think we now have the vaccines. We've got a much stronger outlook for where we are. Rating agencies I've been speaking to recently are talking about annualizing, for instance, the second half of 2021 and treating that as looking at a more normalized, or looking at the 12 months from 2H21 into 1H22. And to put that into perspective, they've actually made a huge change to their sector outlooks. So if you go back to April, May, we had 75% of the 50 or so sectors on negative outlook. This is looking at Moody's numbers. We now have just 5. So we actually have now more positive outlooks in sectors than we have negatives. So I think you can see how they're changing, where the outlook is going, and hopefully it's a bit of a fillip for some of our clients.
Yeah, that's great. And thank you for that. So, Richard, filling out the story, equity markets.
Yeah.
Where were they in March last year, and how were investors feeling about life in general?
Well, I think it's fair to say, I mean, as we all felt, obviously there was a huge amount of uncertainty, and uncertainty in equity markets usually means volatility and big red numbers on the screen, which obviously we saw a huge amount of globally in secondary markets in March. I think the indices, particularly with the sort of growth in electronic trading platforms and sort of black box driven trading, we saw some huge swings, much bigger than the financial crisis, where you were sort of seeing, albeit very large indices swings of sort of negative 3%. We were seeing double-digit 10% movements in March in the real vortex of the sort of start of the crisis. With that uncertainty, there's always a real fear, a real sort of worry around whether corporates can access the primary equity markets, i.e., raising capital from investors. And I think that was the real test. And when HSBC and the equity team, when we saw what was developing in March, clearly there would be some sectors affected overnight. Anything related to travel, retail to some extent, and clearly there was going to be a lot of need for equity issuance. And I think obviously that was borne out through the year. We saw a huge amount of issuance in the UK market through the year, sort of about 52 billion sterling raised through the year in about 120 transactions, over 100 million sterling. And that's sort of just to put into context, that's about a 70% uptick on 2019, which wasn't a light year. So it was a big year by volumes in the UK market. And I think it's fair to say, within this time zone, the UK probably was at the blocks first in terms of COVID-related equity issuance from corporates. Really started in March and April, and I why is that? I think that is a function of probably mostly the flexibility and to be fair, the speed of which investors reacted, corporates reacted, but probably most importantly, I think the regulators and the regulatory bodies around the UK market. As people will know, the preemption group put in place very quickly in early April a relaxation of limits around non-preemptive capital raisings, equity capital raisings, what we call cash box, usually limited sort of 5 to 10% of market cap. That was lifted to 20%. And that allowed a lot of UK issuers in distress or need of emergency liquidity to come to market very quickly. You know, some of those transactions we put together in March and April over a weekend and were out to investors, you know, within 7 to 9 days. So you're talking about raising a very meaningful amount of your market capitalization within, let's say, 14 days from a standing start. So a huge catalyst for the UK market to spring into gear. Now, people didn't know that you could raise money in March. We did the SSP transaction, which I think is fair to say is the first major FTSE 350 transaction to raise COVID capital. That was fantastically well supported. And that gave everyone in the broader market the confidence to then go out to investors and look to raise that capital. We saw a flurry, obviously, of similar 20% cash raisings in the months after that, largely around liquidity needs to begin with. Clearly, you know, the companies that were most in need were those that had revenue go 100 to 0 overnight. But then as we went through into the sort of late spring, summer months, that the use of proceeds started to shift a little bit into the leverage world. So we saw some leverage transactions more around anticipating refinancing needs or bringing in sort of net debt to a level which is slightly more sort of consistent with a tougher, broader environment. And then I think probably most interestingly during the summer, we saw the structure of equity raises continuing. So still the cash placing, but very much moving into a front-footed world. So we started to see some war chests being raised by PLC, and some equity raises related to M&A. And I think that started to test investors' tolerance a little bit. People were clearly, don't have infinite cash at that time of the year. And I think people started to push back on these raises a little bit, and pricing started to get a bit wider. So we started to see a little bit of a slowdown in that placing structure towards the end of summer. But of course, then came the sort of big, what we call documented raises, i.e. where you need a prospectus. So things like a rights issue, which is a 4 to 5 week execution timeline, coming out of sectors like the airline industry is an obvious example, IAG, the BA owner, of course, and Rolls-Royce, who obviously did very big rights issues in that time, which were well expected by the market, did fantastically well, very well supported, and showed that actually there is the capacity in the UK market to support these sort of transactions. How do we see it continuing? I still think in 2021, obviously there's going to be a different shade of equity transactions this year. I think there's going to be more IPOs. There's definitely more M&A coming. We've got a lot of M&A expectations for this year, but there's still going to be COVID-related issuance. Clearly we've had all the uncertainty of the autumn lockdown, the most recent, more sort of penal lockdown. Let's say, I think there's some issuers that have probably held on, managed their cost base and liquidity profile very well, but probably are being pushed over the edge now. And there may even be some repeat issuers, those that have maybe raised early in the crisis coming back. So it's still going to be busy. I don't expect, I hope, candidly, the velocity of distressed situations won't be the same as last spring and early summer. But I think what's encouraging from my perspective, I focus on the UK. What's encouraging, I think, is that the equity market functioned fantastically well, very quickly for corporates in need. And particularly in the UK, as I say, I think the UK in this time zone has really been a shining star of support for UK PLC, for listeds.
Yeah, I think it's definitely been an interesting lesson for people that the equity market is much more available than perhaps one might think from first principles. Traditionally, you'd only ever look at equity as a last resort. It feels very much as though through this crisis, that mindset has changed somewhat, and it is much more in the arsenal of possible solutions for people.
I think that's right. I mean, the one thing, I think that's completely right. I think the old adage, as an equity person, you raise equity, as you say, last resort, and you minimise equity because it's your most expensive weapon in the capital structure. I think this year, we have seen investors be much more, I wouldn't say laissez-faire, but much more relaxed around ultimate pricing in a placing, size of the placing, you're always expected to raise once every 5 years or 10 years and no more. I suspect that's probably eroded a little bit. And I think we've seen equity investors take a much more active role in the debt solution as well, the debt side of the balance sheet, and to get a all holistic capital structure solution. And we had some transactions candidly where those debt solutions were renegotiated in the final hours with equity investors involved. So it felt like a very much a collaborative effort during those sort of difficult months across both sides of the balance sheet.
Yeah, I would fully agree with that point, Richard. I mean, from my perspective, I think the deals that have, certainly been, very well received, very well executed, are those deals that we've seen a combination of debt, in terms of the bond market, equity, and also the bank market very much working together. So, you have the equity issuance to sort of fundamentally, potentially restructure the balance sheet. You go to the bond market in terms of really terming out your near-term maturities, and then using the bank market to raise your incremental liquidity alongside that. I think that combination has worked, really well for a number of companies during COVID.
And actually, that leads really neatly into a question that I've got for Graham, which is about seeing a shift in corporate approach to this holistic capital allocation, financial policy approach. Is what you're seeing backing up what Richard and Laura are talking to?
Yes, I mean, very much so. I think my first 6 months, as I said, I actually was dealing with a lot of the government schemes, the CCFF scheme, and trying to help unrated issuers get access to that CCS scheme, trying to see if, for instance, DBRS could give them a quasi-investment grade rating just to give them access to capital. I think by July, August, September, that was coming towards an end. And interestingly, as companies are approaching their year end, what we're seeing now toward, I would say, last quarter of last year onward is a review of financial policy. Did we have the right financial policy? Obviously, it depends on where you are. If you were broadly insulated from the pandemic, it's not so much of a question. But for many other corporates who didn't have to have very significant issues, they've questioned that financial policy. So we're getting involved in a lot more on that side at the moment. And I would say overall, what I'm expecting to see is leverage come down probably around half a turn to a turn and across a large number of issuers. And actually where we've seen that most is in terms of it actually happening has been in the M&A side. For companies who have a stated financial policy, what we're actually seeing is before, if they had a policy of say 2.5 to 3 turns of leverage, they'd have gone out for a strategic acquisition at maybe 3.5, 4 turns with a view to coming back within policy within an 18 to 24 month time frame. Whereas what we've seen now is a shift. And we're seeing very few companies pushing out beyond that initial financial policy and actually looking at the upper end of that existing policy for where they go now. So capping that leverage at around 3. And as I'm sure, as Richard will comment later, the equity capital markets seem to have mirrored that particular view, looking to have a more conservative approach to M&A. The other thing, I think Laura touched on it, is it's not just about maybe bringing your leverage in a little bit, it's also about terming out what debt that you have there. And for those companies that have got access to capital markets, not the bank market so much, what we've seen is a lot of liability management going on, literally trying to extend the average tenor of the bond debt. Yeah, partly taking advantage of really quite cheap yields, but actually mainly more focused on risk, trying to mitigate the risk and pushing it out longer to give themselves more breathing space should anything else happen again in the near term. As I said, when we think about capital allocation, I've touched on M&A. We've clearly seen it push up really quite significantly as last year went on, and again into this year. People tend to forget that the financial sponsors still have a huge wall of money, and there's a lot of very attractive targets out there for, unfortunately, those corporates who didn't necessarily weren't necessarily as well structured going into it as they might have liked. We've seen some depressed valuations there, and also we're seeing some of the better positioned corporates looking to take advantage at this stage. So M&A definitely growing on the capital allocation side. But before you get to that, there's dividends. And so many corporates have cancelled that dividend, reduced that dividend, or seen the growth in their dividend reduce. And for a lot of those companies, once they've got those leverage policies sorted out and they've got the leverage back into place, which has actually been quite critical for many of them in their dialogues with the rating agencies as well, demonstrating that adherence to financial policy. What we're seeing now is they're looking at, again, when do we turn the tap back on again? So if through all of their actions, particularly on the cost base, which so many have done so well, they're actually potentially in a position to restart dividends maybe earlier than they'd initially thought. So we're having a lot more discussion about that. But also, what is the right dividend policy? So a number are taking the opportunity to rethink, was the dividend policy I had before the right policy? So if you're running a progressive dividend policy, or you maybe thinking of moving to more of an earnings-based policy, which allows a little bit more volatility to play through, or maybe moving more towards a free cash flow based policy, which makes you less adherent to earnings and maybe more with the cash that's in your business. So we're definitely seeing a change there, and the two are coming in balance. So potentially slightly lower leverage and a slight change in the dividend policy. So say those are probably the biggest things. I mean, Richard, in the equity capital markets, you talk to the investors, right? How are they perceiving this?
Well, I think you're bang on. I mean, taking leverage to begin with, I think leverage tolerance in the investor level has come in alongside, I think, issuer and board tolerance around leverage. As you say, and as I mentioned earlier, I think M&A discussions, M&A activity has definitely picked up in the last couple of months. And to the point I made earlier around minimizing the amount of equity an issuer may seek out, I think that old way of doing things has actually probably receded a little bit, and I think now boards are saying, actually, let's not push the envelope on leverage anymore. Let's stay within our medium-term targets, as you say, and let's not look to overstretch the balance sheet to drive returns in these transactions. And I think investors are supportive of that. I think people would much rather put a bit more of an equity check to an issuer to maintain that level of flexibility, particularly because that level of flexibility also allows a corporate to make to have other opportunities rather than feeling a little bit hamstrung by a balance sheet which is a little bit more restrictive. So I think that's exactly right, and that's a trend I think is going to persist for probably at least the next year or two, at least while this uncertainty and balance sheets recover. I think on dividends, it's an interesting point on dividends. It depends who you talk to, and many people on this call will have a register which is full of dividend income only investors, and I'm sure they will have a very specific perspective around restarting of dividends and obviously be quite vocal around that. I think personally, many investors that you talk to, particularly active investors nowadays, because you tend to see the sort of income-hungry, income-only investors be a bit more on the passive side. I think the more active investors will often say to corporates, in our experience nowadays, actually, paying a dividend is fine, and you're on the dividend list, and that's right. But actually, don't overpay, because we want you to invest in inorganic opportunities or organic, i.e., growth capex, where you can drive a better return than returning that capital to me as an investor, particularly with the inflows we're seeing into equities this year. So I do think there is a middle ground, and I think Graham's exactly right. I do think issuers will take this opportunity and should take this opportunity. And I would definitely counsel issuers, engaging with their register more to actually find out really who has sensitivity to a sort of high level of dividend, because I think nowadays there's a real the real thirst for equity investors at the moment is growth. Sustainable, resilient top line growth is what people are really happy to pay a premium for at the moment. And I think dividend is an important component of demonstrating good cash flow, a strong balance sheet, but equally, a classical market plus dividend is not necessarily the be all and end all that it may have been a few years ago for every sector.
Okay, that's a really interesting thought, Laura. So, given the particular focus on growth, perhaps rather than short-term return, how have you seen corporates' approach to liquidity and refinancing change?
Sure. Well, I think at the moment it's still quite a mixed picture. although I suspect we will see things normalise further over the course of this year. So yes, clearly, in the first half of the year, the bank market was used very heavily in terms of raising incremental liquidity. But typically, these were, all short-term or sort of bridging type structures, rather than being viewed as new core long-term liquidity. And to Graham's earlier point, I think for those corporates that did want to retain, the comfort of having that extra liquidity on their balance sheet, typically these have now all been refinanced in the capital markets on a longer term basis, rather than relying on bank support over the long term. It's a pretty similar story as well when you look at the government support schemes. So taking CCFF as an example, peak drawings under that scheme were on the 24th of July last year, when we had 68 issues outstanding for a volume of just under £19 billion. And then when you look at the same data from last week, there are now only 49 issues outstanding with volumes of just over £12 billion. So, clearly something has happened. We have seen liquidity being retired or paid back early. But I do think when it comes to CCFF, a note of caution, I guess, in terms of, what is the driver behind the early repayment. And I think also it's important to think about the disclosure required around the scheme, and limitations going into this year on things like management pay and dividends as well, if you do have outstanding drawings. I think the other important point to consider here is the position in terms of bank lending. So we're seeing much more lender discipline around return levels. So obviously the combination of incremental liquidity requests last year, the general decline in the quality of banks' lending portfolios due to COVID, this has all resulted in some quite material pressure on bank returns. So the market has adapted to this. So there is very clearly at the moment a preference for shorter dated facilities. So, for example, looking back to 2020, we were seeing almost half of all loans with a tenor of 1 year, compared with 25% of loans for 2019. And certainly in terms of full refinancing transactions, the recommendation is very much to go for 3-year tenor today, rather than really pushing for that 5-year tenor, unless of course you are prepared to put very material pressure on your lenders to accept 5 years, or you're willing to have a fairly material pricing increase. And so on the whole, I'd say we've seen a much more cautious approach to refinancings, with refi volumes generally, much lower over the last 12 months for obvious reasons, and borrowers often looking for more of a short-term extension, with the view to wait for greater market clarity going into 21 before they do a full refi. And also, those deals that have come to market have been pretty consistent in terms of coming with wider margins as well. So there's certainly a pricing premium out there. Now, I do think that as we get more visibility on the hopeful COVID exit, I think we'll start to see more refinancings coming to market, and certainly given the backlog from last year, that will have to happen soon. And I suspect we will in time, start to see more competition return to the market. So we'll see 5-year tenor pick up. We'll see pricing levels normalize. But I do think over the longer term, there will be this underlying focus on capital allocation for banks. And I think there'll be a lot more scrutiny around the business case for supporting revolvers. As we all know, when banks provide balance sheet support for RCFs, that's typically always loss-making on a standalone basis. I think. Sorry, Sarah. No, just perhaps one more point on this, just to sort of confirm Graham's views as well in terms of the types of discussions that we've been having with corporates. I think the other key trend here is corporates looking around funding diversity and the options they have available. So I think, it's very clear that corporates are looking to become, more nimble, more able to adapt to a changing environment. And certainly we're having lots of discussions around, possibly tapping bond markets, looking at CB hybrid as alternative financing options as well.
That's very helpful. Thank you very much. And actually, there's a couple of points that we haven't touched on and that we'll need to return to at some point, which is the impacts of ESG and also
Indeed.
the LIBOR transition that,
yes,
it's my favourite topic for anybody who's ever heard me speak before. But anyway, we have actually got to the end of our time. That's passed really quickly. I'd just like to say thank you very much indeed for all the questions. And I hope that we've managed to address a number of the questions that you've had. As I've mentioned previously, you're welcome to follow up with panelists later today in the exhibition hall. And a reminder that you can watch this session again on demand and continue this discussion directly with the panelists. Please do complete the speaker feedback survey. That's very helpful for us to understand how we can improve these events. Finally, I'd just like to thank HSBC and in particular, Graham, Andrew, Richard and Laura. Thank you very much.